We're going to be doing a review of my personal charts here in this session. But one thing that I want to do with you guys is also is just relate it back to your charts, right? I'm going to speak kind of I'll cover my charts and the way I look at everything, but I want to kind of relate it back just in case you don't use my indicators, you have some other indicators, whatever it is. I want you to be able to tie it all together because really the point of this isn't necessarily just to show you my indicators and how I use them, but more so just in terms of conceptualizing indicators and how you should use them. So let's let's dive in here. And bear with me just 1 second. All right. So what is the most important indicator on any chart? If anyone wants to take a guess there. What is the most important indicator on any chart? There is a right answer. Yep, price. Price, 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 price. People seem to forget that. We start putting all these cool, fun things on our charts, and we forget that the most important thing, from which everything is basically derived, is just really just the price, right? So let's just start with the basics before we get into anything that's like proprietary. So when it comes to price, there's two things to look at. There's going to be either horizontal support or resistance, right? Previous highs, previous lows, right? These are the most important things. These kind of horizontal support levels. You should be able to see them, although we do have indicators that will just show them to you. And you see the previous highs, the previous lows. So that's structural support, right? So be sure that you have something for that, even if it's just your experience, your eyeballs. Just know where these levels are, because this is definitely the most important part of the price chart, is where the previous support and resistance levels are. From there, we build on top of that, right? That's kind of the easy part, just horizontal lines across previous highs and lows. But then we can add a little bit more color to that, right? If those levels are kind of like the bones of the system, then we can add a little bit of kind of like what is the muscle of the system. And in that case, it would be the moving averages. So this is going to be the first step here where I'm going to ask you to maybe write this down or maybe just consider it going into the weekend. But ask yourself, what moving averages are you using, right? And write them down. And then next to each one, say, what does it mean, right? So the 8, that would be an aggressive trend moving average. The 21 would be kind of the normal standard trend moving average. The 50, which would be something like structural, right? I would view the 50 as weak trend and the beginning stages of structure. And then the 200 I would view as the weakest trend, right? Good trends don't move on a 200, they move on a 21. But it's also the strongest structure. So even if you use more than what I just said, let's say you use a 34 or a 55 or an 89, whatever it is that you use, just be able to make sure that you can conceptualize why it is that you're using that moving average and what information is it providing you. And the thing is, I've seen a lot of folks charts, they have a lot of moving averages, right? You'll note on my weekly chart here, I only have 3. I've boiled the entire system down to 3. And I think, frankly, it's enough. So the blue line is the 50. The green line is the 21 EMA. And the red line is the 200 SMA. And from that, it tells me pretty much everything that I need to know. This tells me the kind of conventional strong trend. This would be more of like a weak trend with the beginning stages of structure. And then the 200 I would use as just a structural moving average. So that's kind of the bones and the muscles of the chart, if you will. Always try to focus up here first, right? I see a lot of folks that want to focus here or on the arrows, and it's a process. You want to work from the top down. After that, then you're going to see the Squeeze Pro, right? Now the Squeeze Pro is pretty simple to talk about because we're all here because of the squeeze. And the Squeeze Pro is also very unique. So while you may have different moving averages than I do, or you may have different trend momentum indicators than I do, chances are you're using the squeeze in some capacity, right? The squeeze is unique just because it gives you, unlike anything else, it tells you when you have compressions lead to expansions, right? I mean, we're all familiar with that, so we don't have to spend too much time on that, but that's basically the premise. I haven't found anything else that really does the same thing as the squeeze does, so because of that, it is a unique indicator that should be used on almost every chart. So then let's get down to the bottom part of the chart here. This is where it gets a little bit more nuanced and a little bit more interesting, perhaps. So one point that I'm going to make is that I think every trader needs 2 trend indicators. Why do you think that might be? If anyone cares to take a guess there. Confirmation? No, it's actually not confirmation. Although you can think of it that way. It looks like a couple of you answered that. The way that I'm thinking of it is more so you're always going to have phases, right? So think of it like a hammer and a screwdriver, right? If you're a carpenter, would you rather have 2 hammers and no screwdriver, or 2 screwdrivers and no hammer, or would you rather have a really good hammer and a really good screwdriver? And the answer is probably a really good hammer and a really good screwdriver, because in your career as a carpenter, you're going to run into as many nails. 50% of the jobs are going to be nails, and 50% of the jobs are going to be screws, right? And if you happen to come across one of the jobs that's a screw, if you follow my analogy here, and you only have a hammer, it's not going to go great. If you run into something is a nail, and you only have a screwdriver, it's not going to go great. So markets are kind of the same thing. In markets, you either have a trend. Right, we all know what that looks like. So markets either look like this, and this would be one job for one indicator, or markets look like this. Right, and most of the time, they actually look like this. So if you're trying to use a trending indicator in a market where price looks like this, it's not really going to work, right? It's like using a MACD on one of these sideways charts. It's just going to give you a bunch of false signals, and basically you might as well not even use it. So the answer is, the reason that I personally think that you need 2 momentum indicators is because you're going to run into 2 types of markets. Either they're going to be trending up or down, market 1, or they're going to be going sideways, market 2. And most of the time they will go sideways. So the homework that I would put back in your bucket is, okay, now that we understand we need at least 2 tools to tackle these 2 different market phases, ask yourself on your charts, which one is your trend momentum indicator, and which one is your range bound momentum indicator, right? And then know when to use which one. So it always goes back to the top part of the chart. So for example, here on the Google, you have basically a range bound market here, right? But it also came from a trending market. So you see how the personality of the market shifts? There you have an uptrend. Here you have a downtrend. And here you have a sideways trend, right? So be sure that you can articulate in your own words why you're using whatever indicator it is that you're using. For trending indicators, you can use a MACD, an RSI. You could use a trend oscillator. You could use the Moxie. There's any number that you can use, and many of them are free, so you don't have to buy anything. For a range-bound market, you can use something like a slow stochastic. You can use an RAF, Ready Aim Fire. You can use the High-Low Pro, etc. And that's basically it. I don't know how much else we would need to necessarily cover, because really what I wanted to do with you guys today, and I'll take some questions if you have any, but what I really wanted to do with you guys today is just kind of kick this back to you. You're going to have a 3-day weekend coming up. I want you to look at every pixel on your chart this weekend and confirm, why is it there, right? Because if you have like 50 different moving averages, why do you have so many, right? And there might be a very good reason, but at least be able to answer it. If you have only 3 moving averages, why do you have so few, There might be a good answer for that, but make sure you can answer it. And Carol, to answer your question, what do I mean by structure? Structure, think of it like the bones, right? So for example, and this is always the most important thing, is structure is like previous highs and lows. So there's structure right there. Here's a previous low, right? Here's a previous low, right? These are the most important levels. So basically, if I were to look at this chart and just simplify it, there's clearly a high here, and there's a pre-drawn low in here, right? So what I mean by structure is just here's your resistance, pretty clearly. Here's your support, right? Now these are static levels, meaning that they're not moving, they're not changing dynamically until you make a higher high or a higher or a lower low. That is different from moving averages, because moving averages are constantly moving, right? As hence the name. So if you're trending, meaning that your moving averages kind of look like this, where they're stacked fast to slow, then you can use trending moving averages, right? But if you're not trending and you're going sideways, you really want to rely much more on sideways structure. So that's what I mean by just structure versus trend. Structure is like the static stuff, the previous highs and lows. Trend would be moving averages. But you have to know when to use which, because if you're not in trend and you're trying to use moving averages, you might as well not use them. For RSI, I personally prefer the RSI for more of a trending market. But your mileage can always vary. At the end of the day, really, whatever it is that you find to be successful, that's what works best for you. But in my opinion, an RSI is better for a trending market. What would you consider a free range-bound indicator? A slow stochastic. A slow stochastic on a 21 setting. So just slow it down a little bit more. Out of the box, I think it might come out of the box with a 10 period, which might be a little bit too fast. So you can use the out-of-the-box slow stow. It's free. It's built in. Just put it on a 21 period. Do I consider a trending channel to be structure? No, not really. So you're meaning something kind of like this. And you'll have to excuse me, my computer's really lagging right now for some reason. But like kind of loosely like that. Is that what you mean? I wouldn't, because in this case, you notice how the lines for a channels tend to look like this. I don't consider that structure personally, but I guess it really just comes down to semantics at that point. The reason I don't consider that structure is because it's not a sideways level. So whenever you have like trend lines, I also don't personally consider structure, right? Like here would be kind of a trend line here, right? Excuse the lag there, but you see kind of how that trend line, or here's another trend line, but you see how they're angled. I don't personally consider that structure. Structure to me always has to be horizontal. The trend line, nothing against trend lines. I like trend lines, but in reality, they're nowhere near as strong and consistent as levels like this, right? When you have actual horizontal support and resistance levels like this, these tend to be a lot more strong. CCI for a trend indicator, I think that'll work. Yeah, I think CCI is fine. Yeah, there's any number that you could use. So I think pretty sure CCI is free too. So I think that one's fine. There's PPI, MACD, RSI. There's hundreds really. It's just a matter of what resonates with you. Flags and pennants are, for me, no. Flags and pennants are not structure. Now again, we might be getting into semantics here, but structure to me is like the bones of the system, right? So like for example, could you call this a bear flag? Probably, right? I wouldn't consider this structure. I wouldn't consider that structure. I would consider this low structure. So structure, just in the simplest way to me, is just horizontal previous lows and previous highs, right? Once it goes from support, God, this computer's lagging so bad. Support becomes resistance, can then flip back to support. So that's kind of the idea. All right, guys. Last call for any questions if you have any. Kind of a quick session, but really I just wanted to kind of put back into your pocket because you're going to have 3 days this weekend. One, just understanding the difference between trend and lack of trend and how that determines what indicator you use. If you're trying to use a slow stochastic when you're in trend, it's not going to work. If you're trying to use a MACD when the market's going sideways, it's not going to work. And it'll just introduce needless noise into your analysis. So the first thing is always start at the top of the chart. Ask yourself, what is price doing? Are the moving averages going sideways? Are they trending? And then from there, you then fall back and can use your indicators. Now, let me show you kind of one perfect example here. This came up earlier in the day, and you guys guessed earlier that the indicators is kind of confirmation. You can, not always. This is somewhat rare, and these are very good moments in time to do it. But let me show you one decent example here. And then we're gonna cut it there, and we're not gonna do any additional chart work or anything like that. So you can catch me on HYG or SPX. We'll cover that one next week. I just want to, because we're recording this session too, so I want to make sure that we can have a pure recording of the chart work. I apologize about the delay here. The computer's very overworked right now. There it is. So let's just kind of go from the top down on this chart. I'm just kind of, I picked this one because it came up earlier and it's just really a decent example of the idea. Let's let the trend oscillator load here. Everything's moving really slowly. But we'll do this kind of top down work using all the indicators, and then we'll call it a session. So if we look at the weekly chart, is this a range bound chart or is this a trending chart? You don't have to answer. It's a pretty easy question. It's pretty clearly a trending chart, right? You have the structure, meaning you have the angle, right? You have to have an upward angle to your moving averages, and they have to be stacked like that. So we know we're dealing with a trend, right? Now, if we look at the daily chart, you see how it goes from sideways right here, and then once all the moving averages flip, probably about right here, where the green, the blue crosses the green, or excuse me, the blue crosses the red. You see how it goes into trend? Okay, so even without any indicators, or at least any momentum indicators, we already have an idea of what we're looking at. We're looking at a strong trending chart. So the indicators, now that we've understood that, the indicators down here, in my case the trend oscillator, tells you that when the green line crosses through the red line and they're both above the middle line is the white line here, that is a good move. So do you see how in this moment in time right here, where you get the crossover here and you get the thrust up signal here, do you see how that can kind of lead you into a trade? That's a pretty strong bit of alignment. Now, you shouldn't always expect this to happen, but if you can ever get your momentum indicators to line up like this, understanding that they have different jobs, but when both jobs are lining up and telling you the same thing, those are the strongest signals. So those two circles are one example. And then if we look forward, you had another thrust up signal here, and you are already in trend, and you are at support, right? And then from that comes the next push. So slightly more advanced there to just close it out, but just kind of a top-down point of view. Start with the top chart part of the chart, decide whether the chart is in trend or in chop, and then use your lower indicators to determine the quality of that structure. All right, so we'll close out with any questions if you have any, as the market just pumps away. The only thing I'm in right now is short GE, and it's dying to go green. experimenting with which moving averages to use. I would start with the 2150 and 200. 21 EMA, 50, and 200 SMA, and then you can build it out from there. You can add the 8 later. What I don't think you want if you have a lot of moving averages is for them to be very close together, right? So like for example, I've seen people that use the 8, 13, 21, 34, 55, right? And those two, they tend to be too close together. So what I want is kind of like the 3 bears kind of moving averages, where the green is the strong trend, blue is medium trend, red is weak trend, and then everything else kind of fills in from there. In Chop, yes, rely a lot more on the High-Low Pro or whatever it is that you use that you use as a range-bound indicator. I'm not sure what you mean by that, Carol. Okay, last call for questions if you have any, and then we'll call it a session. It is a 3-day weekend, and we got a rip-roaring 200-point move on the NASDAQ off the lows. Totally standard. Okay, well, I'm not seeing any more on the current chart. We're there. We were talking about alignment. So, just very quickly, we without any indicators other than just the price and the moving averages, we know that we have a trend, because this is what trends look like, right? The moving averages are sloping up, and it's a trend. Now, the trend oscillator is confirming that. It won't sound, it's not very mind-blowing because it's such a strong trend and it's being fully confirmed by what this indicator looks like. Sometimes it won't. Sometimes it'll look like trend and the trend oscillator actually won't confirm that. But in this case, this is just standard and it does confirm it. So we have a trend here. We have a trend here. What we're looking for is alignment after that. So if you look, there's a crossover here and up thrust that happened at that exact moment right there. And look what that leads to. Then we look for that to happen again. It does not happen again until right here. And look what that leads to. So these are rare moments in time, but if you can get the alignment across your indicators like this, and you don't have to look for the alignment. Really the much more common thing is going to be, are we sideways or are we in trend? Then let me use my one indicator for that job to trade. But when you get alignment like this between the indicators, the trending and the non-trending, those are actually very rare moments in time, but they're also very powerful moments in time. So if you can find those moments in time, it tends to work out pretty well. Best free trend. Well, I won't go so far as to say best because best is subjective. But if you're looking for range-bound indicators, I would certainly just say use a slow stochastic set on a 21 period. It's free. It's built into every platform. Works pretty well on range-bound markets. Slow stochastic, 21 period. For trending indicators, you can use a MACD. You can use an RSI. You can use a CCI, Commodity Channel Index. If you're looking for one to just start off with, I would probably suggest a MACD, just because it's very simple, and then you can build out from there. All right, guys, that is my time. Thanks for attending. Always fun to have you in the room and to be able to chat with you guys. Have a good long weekend, and I'll catch you guys back in here next week. Cheers. Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm. And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.